Whenever a company releases its earnings report, the big headline numbers tell you what happened. But the real story, the why, that's almost always buried a little deeper. And let me tell you, with Sunoco's latest report, that's where things get really, really interesting. And looking at Sunoco's fourth quarter results for 2025, confusing might be the understatement of the year. Honestly, if you just glanced at the headlines, you'd think the company had just driven full speed into a brick wall. At first glance, the report looked like a total disaster. Let's break down the two big numbers that caused all the commotion. Okay, first up, earnings per share or EPS. The experts, the analysts, they were all expecting a pretty solid $1.64. What did Sunoco actually deliver? 9 cents. That is not a miss. That is a chasm. I mean, it's the kind of number that makes your jaw just hit the floor. And the revenue side of things? Just as jarring. Wall Street was looking for over $9.5 billion. Sunoco came in at $8.6 billion, a full $1 billion short. So we've got a massive miss on earnings and a massive miss on revenue. So the natural question, the one everyone was asking, is what on earth happened? Did the business just completely fall off a cliff? Well, here's the twist. The answer is not what you'd expect, and it all comes down to one single massive event. It turns out this wasn't really a story about failure at all. Nope. This was a story of transformation. You see, a huge company-altering acquisition was completed right in the middle of all this, and its effects just rippled through every single number in the report. So, on October 31st, Sunoco officially closed its deal to buy Parkland Corporation. And this wasn't just some small bolt-on deal. The company itself called the entire year transformative because of this one event. It literally changed the size, the scope, and the entire structure of Sunoco practically overnight. And you better believe the company is confident about this move. The CEO, Joe Kim, he didn't just call it a good deal. He called it a home run. Now, that is a big statement, and it's the real key to unlocking what actually happened this quarter. So to really see that home run, we have to become detectives for a second. We have to look right past those messy headline numbers like EPS because they were totally distorted by the whole acquisition process. We need to find the one metric that shows us the true core health of the business. And here's the culprit, the smoking gun, right here. The company had to spend $60 million in one-time costs just to make this huge deal happen. We're talking about legal fees, integration expenses, all the stuff you have to pay for when you buy another giant company. These costs slammed the bottom line, but they have nothing to do with the normal day-to-day business. And this is where a metric called adjusted EBITDA becomes our hero. The best way to think about it is this. It's a special lens that lets us see how the business is really performing day to day. It completely ignores all the noise, things like taxes, and most importantly for us, that's $60 million in one-time acquisition costs. It gives us a clean, clear picture of the company's operational health. And bam! Once you strip out those costs, the real story just jumps off the page. Sunoco's core earnings didn't shrink, they exploded. They rocketed from $439 million in the same quarter last year, all the way up to $706 million this year. This is the real story. This is why the company was calling it a record quarter. The core business is stronger than it has ever been. So, all this new earning power, where did it come from? Well, this financial growth is a direct result of physical growth. The Parkland deal didn't just make Sunoco's numbers bigger, it made the company itself way bigger and way more global. I mean, listen to the company's chief operating officer, Carl Fales. He puts it perfectly. This isn't just a U.S. company anymore. We're talking about a massive operation spread across 32 countries and territories, making them the #1 independent fuel distributor in all of the Americas. That's a huge change. So what does this new footprint actually look like on a map? Well, you've got the legacy U.S. business, and now you're adding major assets in Canada, a huge expansion into the Caribbean, and even a brand new foothold in Europe. On top of all that, they've added an entirely new business segment in refining. This is a fundamentally different company than it was just a few months ago. And they're not about to slow down and admire their work. Not at all. The company laid out a super clear, very aggressive game plan for what's coming next, basically telling everyone that this growth spurt is just the beginning. So looking ahead to 2026, they're forecasting their adjusted EBITDA, that key metric we talked about, to be somewhere between $3.1 and $3.3 billion. Now, that's not just a number on a spreadsheet. That is a powerful statement of confidence in the massive earning potential of this new, bigger company. And to keep that momentum going, they've committed to spending at least $500 million. That's the floor, their word, on smaller, bolt-on acquisitions every single year. This isn't a one-time thing. They're telling the world that constant, aggressive expansion is now part of their DNA. And for investors, here's where the rubber meets the road. All this growth translates directly into returns. The company is now targeting distribution growth of at least 5% every year. It's a crystal clear promise. As we get bigger, so will the checks we send to our unit holders. So what does this all add up to? How should we really think about this new and improved Sunoco? Well, they argue that they've pulled off something pretty rare. They've become the best of both worlds. The CEO sums up this new identity perfectly. He says the company is now both a thoughtful defensive play, meaning it's stable, it's resilient, and at the same time, an attractive growth story. They've built a much stronger foundation, and now they're ready to build a skyscraper on top of it. Which, of course, brings us all the way back to where we started. When is a huge miss on earnings actually a win? Well, now we know. It's a win when it's just the temporary cost of a game-changing investment, one that sets the stage for a much bigger, much stronger, and much more profitable future.